Good day, grade 10s. Welcome to yet another exciting episode of Business Studies. Today we will be doing forms of ownership, but we will be looking at 3 forms of ownership, which are personal liability company, private company, as well as public company. But we will be looking at the application as well as practice questions. Now let's start. Our first practice question says, outline the differences between profit and non-profit companies. Profit companies, these companies are formed with one aim of making a profit. So with profit companies, when these companies are incorporated or are started, they are started with one specific aim, of which is to generate the profit. Whereas with non-profit companies, these companies are formed for charity purposes or to promote social and cultural activities. With non-profit companies, these companies, they are just generated to just assist the community for charity purposes or to assist with social activities or cultural events, maybe trying to tackle some socio-economic issues that are being faced by the community. With profit companies, these companies are incorporated for financial gain for its shareholders. So with profit companies, we have shareholders. So these shareholders, they have to get the return on their investments. So when we start the profit companies, we are looking at obviously the income that we are going to get, the profit that we are going to get as a company, and making sure that the shareholders, they also get a return on their investment since they have bought shares in profit companies. Now, with non-profit companies, these companies are associations not incorporated, not for gain. So obviously, with non-profit companies, there are no shareholders there involved, and they are not incorporated for making any profit because there's no money or return that is going to go to any person because it does not have shareholders. Then profit companies are responsible for paying taxes based on their profits. So with profit companies, based on the profits that they make, they are taxed on those profits. Whereas with non-profit companies, they are not required to pay taxes on net income. So with non-profit companies, the income that is left after they have spent the money on their expenses, paid for their expenses, and then there's this income that is left. That particular income is not taxed because these companies, which are non-profit companies, they are only incorporated for charity purposes to also assist with socio-economic issues that are affecting communities. Now, let's look at our second practice question, which says, elaborate on the meaning of a private company. A private company is a company whose shares may not be offered to the public for sale. So with a private company, this is the company that cannot sell or offer their shares to the general public for sale in order for them to raise capital. But what they do, they offer their shares to their existing shareholders. That's how they raise capital. Okay? It is a legal entity and its operations are less strict than those of a public company. So obviously a private company, it's a registered business. You register this business, then it becomes a legal entity, and its operations are less stricter than those of a public company because they are not compelled by law to audit their financial statements and also publish them for the public to know what is happening inside this particular business that we call a private company. Moving on to the third question. It says, read the scenario below and answer the questions that follow. Surprise and Precious completed their MBA. They want to register a business that will make their directors liable for the debts of the business. Then the question says, identify the form of ownership applicable in the scenario above. So here are two people who have completed their MBA, so this is just information. They want to register a business that will make the directors liable for the debts of the business. So which form of ownership, learners, is applicable in this scenario? That is going to make the directors be liable for the debts of the business. So the correct answer here would be the personal liability company. Well, the second question says, name the document that will enable Surprise and Precious to register the form of ownership identified in question 3A, which is personal liability. So obviously that document is going to be the Memorandum of Incorporation, or the MOI. Let us move on to our fourth question. It says, discuss the characteristics of the form of ownership mentioned in question 3A. Remember, the form of ownership that we mentioned in question 3A was the personal liability company. Now we are looking at the characteristics. Directors have unlimited liability and they are jointly liable for the debts of the business, even if they are no longer active in office. What does it mean? It simply means that the directors' personal assets can be seized to pay for the debts of the business, even if they are no longer in the office. They can go and take their personal assets to come and pay for the debts that they have caused for this particular business, which we call a personal liability company. The Memorandum of Incorporation should state that it is a personal liability company. Why should it state that it is a personal liability company? Because the Memorandum of Incorporation, it is the document that is used by companies when they start their business, when they want to operate. So obviously it has to be stated so that it is clear that which form of ownership is this particular business. So it has to be stated that it is a personal liability company. Moving on to the fifth question, it says, advise businesses on the advantages of a private company. Shareholders' liability is restricted to the number of shares they own. So obviously the liability of shareholders is only limited to the number of shares that they are owning. The debts of the business does not affect the shareholders' personal assets. Information in a private company is only available to the shareholders. So obviously the information of a private company, it does not belong to the general public, but it's only available to the shareholders. Why? Because this is a private company. As we've mentioned also earlier on, that they do not offer their shares to the public, and they have less restrictions or operational restrictions than the public company. The company is a separate legal entity, so it may purchase assets in its own name. So when we say a company is a separate legal entity, we are able to register a private company, then it has its own name. We are able to buy assets with the name of a company. We are able to go and ask for a loan in financial institutions using the name of the company. So since it's a legal person, we are able to do what? To purchase assets, we are able to purchase property, and that property will be named according to the name of the business, because the business is registered. Those assets will belong to the business and not to the owners. Let us go for a quick ad break, and I will see you shortly.